Hello everyone, my name is Jeff Davis. I am the Business Program Chair for the online division of Minnesota School of Business, Globe University, and Broadview University. In this video, I'm going to talk a bit about the income statement. An income statement shows a company's profit or loss over a specific period of time, such as a year, a quarter of a year, or a month, and it does this by starting with the firm's sales, subtracting off all of the firm's expenses, and that leaves you with profit. One quick note right off the bat here, the words profit, earnings, and income are all the same thing, so you may see them used interchangeably. Here is an example income statement from the text. The thing about it is that it looks really intimidating, maybe because there are, 15 lines there. And if this is your first introduction to income statements, there's lots of terms here that you may never have seen before. So what we're going to do here is make this a little easier and then break down the pieces. We said that an income statement starts with the company's sales, which is the top line here, subtracts off all expenses, which is the cause of almost all of the middle lines here, and by doing so leaves you with profit. So to make this a little easier to understand, let's strip it down to its bare minimum here and replace all of this middle stuff. We're going to start with sales, $850,000, subtract expenses, which will total $790,000, and that leaves you with profit, $60,000. Ultimately, this is what an income statement boils down to. So what we're going to do to show more detail is break out expenses into 4 different categories. Those will be the cost of goods sold, other expenses, interest, and taxes. So starting with cost of goods sold, which you may see just as cost, or you may see as cost of sales. Cost of goods sold represent the most direct, absolutely necessary costs of providing whatever the company is in the business of providing, whether it be a good or a service. This can be different depending on the type of firm that you're talking about. For example, if you are in a retail business, let's say you sell clothing, then the cost of that clothing is whatever you paid for it at wholesale. So your wholesale cost is the cost of goods sold. If you are a manufacturing business, it means that you take certain materials and turn them into a finished product. The materials are the cost of goods sold. If we subtract the cost of goods sold from our sales figure, what we end up with is gross profit. From gross profit, we subtract off the other expenses that the firm has, and we refer to these as operating expenses. They include things like marketing, administrative expenses, and also depreciation. Depreciation could most definitely be its own video or its own class, but suffice it to say, depreciation comes from the accounting system that we use when we do an income statement, which is an accrual method instead of a cash method. So what we want to do is best represent how expenses are being incurred. And so if we buy a machine this year during this period that costs $300,000 and it's going to last 10 years, it's more accurate in a sense to say that we are spending or using up $30,000 each year for the next 10 years. So this $30,000 would appear in the income statement every year for 10 years using this example. When we take gross profit and subtract off all of the operating expenses, we are left with operating profit. Operating profit is also called earnings before interest and taxes, or EBIT, EBIT. I especially like using the term earnings before interest and taxes because it makes it very clear what you're talking about. Remember that we have 4 categories of expenses we're looking at: cost of goods sold, which we've taken care of, and operating expenses, which we've taken care of. And so what we have at this point is our earnings before we've taken care of interest and taxes. Operating profit is the term that's being used here in this example, but it means exactly the same thing. Our next step is to take operating profit, or earnings before interest and tax, and subtract off our interest expenses, which will be from loans or bonds that we have out. When we do that, we're left with profit before tax. We've now taken care of all of our expenses except taxes, and we call that profit before tax, or earnings before tax. Subtracting off the income tax, we are left with net profit, profit after all of the expenses that we've talked about have been taken care of. So in summary, we have the income statement, which starts with sales, subtracts off all expenses, and leaves you with net profit. To help you remember this, you will want to break expenses into the 4 categories: cost of goods sold, operating expenses, interest, and taxes. So remember those 4 things. And then you'll also want to remember the terms that you're left with after each step: gross profit, operating profit, profit before tax, and finally net profit.